Hey traders, this video is created keeping beginners in focus so that learning order blocks becomes simple for everyone. We will go through everything starting from basic ideas and moving toward advanced techniques. Whether you are a new trader or an experienced one, make sure to watch the complete video carefully so every concept becomes clear. In this tutorial, I will also explain 3 high-probability trading strategies using order blocks. If you continue watching till the end, you will properly understand how to apply order blocks to achieve consistent profit. This entire video will act as a complete masterclass for order block trading. Let's begin. First, let's understand what an order block actually is. An order block is an important chart area where a large amount of capital enters the market, usually by major institutions or banks. We often refer to them as smart money because they trade with significant funds. Due to their trades, strong price movements appear on the chart. If you notice price suddenly moving upward from a certain area, like here, there is a possibility that institutional traders have taken buy positions. To push the price up so quickly, heavy buy orders are required. The area from which those trades are opened is called the order block zone. There are 2 types of order blocks. Bullish order block relates to heavy buying. Bearish order block relates to heavy selling. In this video, I will show bullish order blocks in this color and bearish order blocks in this color. You are free to use any color of your preference. Order blocks and support or resistance are both significant levels, but they are not identical because there are some major differences. The first difference is that an order block forms because of a powerful price movement. If price moves strongly from a certain zone, that zone can qualify as an order block. Support or resistance is created through repeated rejection. For example, price rejects here and then rejects again here. Then this area may be considered support. The second difference is that order blocks are marked as zones or areas. Support and resistance are usually drawn as lines. Even when drawn as areas, they are thinner compared to order block zones. Third difference is that an order block is mostly only used one time. If price retraces and touches the order block, it becomes invalid. Support or resistance can be tested and used several times. However, both can be combined. For example, if resistance forms on the chart and at the same time an order block appears in the same region, it becomes a confluence level. This is considered ideal from the trading perspective because chances of price reaction become stronger. After understanding order blocks, correct identification is very important. Your trade quality fully depends on selecting a valid order block. There are 3 major requirements for a valid order block. First condition, there must be a price gap, which is also called inefficiency or imbalance. For example, observe this. Price moved upward twice with momentum. Both movements look strong. But in the left example, there is a visible gap between the upper wick of the first candle and the lower wick of the third candle. In the right example, body and wicks are touching correctly, so imbalance is not present. That gap is known as inefficiency. For this reason, only the left movement qualifies as a valid order block. To draw a valid order block, use the first candle before the inefficiency and draw a rectangle covering the entire wick-to-wick range. Second condition, the order block must remain untouched. This means the level has not been previously used. As mentioned earlier, an order block is generally valid only once. If even a wick has tapped the zone, it loses validity. Although there are certain strategies to reuse broken order blocks, we are currently discussing the basics. So for now, remember, a valid order block must remain untouched. Third condition. After the inefficiency, there should be either a break of structure or change of character. Some traders may already understand these terms. If not, let me explain quickly. Every market moves within a structure as long as a trend holds. The market forms highs and lows according to the trend. In an uptrend, price keeps forming higher highs and higher lows. A higher high means price breaks the previous high. A higher low means price does not move below the previous low and create support higher than before. If price breaks above the previous high, it is called break of structure. If price breaks below the previous low, it is called change of character, which means trend reversal. In a downtrend, price forms lower highs and lower lows. When price breaks below the previous low, break of structure occurs. When price breaks above the previous high, change of character happens. So returning to topic, if after the inefficiency there is a break of structure, the order block is considered valid. For example, here, price moved strongly and imbalance created, but price did not go above this level, so the order block is not valid. Once price crosses this level, break of structure occurs and the order block becomes active. To draw it, use the first candle before the imbalance and mark the full candle range. Price also moved strongly here, but because imbalance was not complete, this cannot be used as an order block. After understanding this, now we move towards strategies. Knowing about order blocks is only theoretical knowledge. Applying them in strategies is practical skill, which improves trading quality. I will now share 3 powerful order block trading strategies that will increase accuracy and performance. Let's start with the first strategy, multi-timeframe confirmation. First, identify the order block on the higher timeframe. For example, we are checking Bitcoin chart on H4 timeframe. Here, prices move strongly from 2 areas and imbalance has formed in both, so we can mark both zones. Now let's check if they meet conditions. The first bullish order block is not valid because no clear break of structure is visible and the zone has already been retested by wick. The bearish order block is valid because price created lower lows here and achieved break of structure while staying untouched. Next step is to wait for price to pull back to that order block area. After that, shift to 15-minute time frame and wait for sell confirmation. My preferred confirmation is the bearish engulfing candlestick pattern. When it clearly appears, open a sell entry, place stop loss above the order block, and target minimum twice the stop loss. Use this multi-timeframe reference: weekly with 4 hour, daily with 1 hour, 4 hour with 15 minutes, 1 hour with 5 minutes. Now, second strategy, inducement concept. Before price reaches the order block, a smaller key level is created. In bullish scenario, it forms higher low. In bearish scenario, it forms lower high. Price first breaks this minor level to trap retail traders. Retail traders close buy positions thinking support is broken and open sell positions. Price then reverses from the order block and triggers their stop losses. Through this trap, institutions generate liquidity and open stronger positions for themselves. Therefore, place limit order at the midpoint of the order block. If price does not reach that level, no trade is taken. If price reaches it, best possible entry activates. After entry, stop loss is placed below the order block. Take profit should be 2 to 3 times the stop loss, or at the inducement level, which is the lower high. This structure frequently appears, and even here, after breakout, price went to the order block and reversed. Third strategy, breaker block. As explained earlier, order block is normally used one time, but if an order block gets broken, it can still be used in a different way. Sometimes price pushes through the order block, but later returns to the same zone and reverses from there like a resistance. That setup is known as breaker block.